Ladies and gentlemen, please welcome to the stage Kristen Ishii.
Hey, good morning and welcome back from the break. I hope you all enjoyed yourselves. We have a great panel lined up for you today. We have Robin Wigglesworth of the Financial Times, who's going to be leading our discussion on the future of ETFs. And we want the audience to be very interactive in this session. All of your questions are going to be answered by this star-studded panel. So definitely log into Slido, ask all of your questions. But before we get to that, I would like to just remind everyone that we have our first annual Inside ETFs Fun Run taking place tomorrow morning. That is going to be at 6:30 a.m. and we're going to be joined by one of the elite top distance runners, Jordan Hasay. That can either be a 5K run or a 2-mile walk. You don't have to run, you can walk. And if you would like to register for that run, please visit the Fun Run booth right outside of the main session room. And just a reminder, if you have already pre-registered, please just go out there and pick up your shirt so you'll be all set for tomorrow morning. Now, we've had the pleasure of partnering with John Hancock to put on this fun run, and our Inside ETFs community has been so generous with donating, excuse me, to Save the Children, our charity partner for this year. And Save the Children is an international charity foundation that supports children all over the world, so we'd just like to give them a little brief introduction.
Our world is facing many challenges. We often wonder, how can we make a difference and create a brighter future? We believe investing in childhood is the answer. At Save the Children, we do whatever it takes to ensure that every day, children in need grow up healthy and educated, are protected in times of crisis, and reach their full potential, transforming the future we all share. Join us at SaveTheChildren.org. Invest in childhood today for a brighter tomorrow.
Great, thank you. So again, if you'd like to register for the fun run or pick up your t-shirt, that's just right outside the main session room. And if you'd like more information about our charity partner, Save the Children, they also have a booth out there. They have wonderful programs going on all throughout the year that you can learn about there. And without further ado, let's get the panel started. I'd like to invite up Robin and the gang.
Hello, everybody. Thank you very much for joining us. I'm confident that this will be a tremendous panel, the greatest panel. And everybody isn't here is going to be so sad for not having been here. Obviously, we have an all-star panel here, excluding me. But we do want to make this a bit more interactive than most of the other panels. So you can go to slido.com and actually enter in questions that you would like to ask the panelists. If there's an individual one or one that you'd like to throw out to everybody, just enter it in there, send it through. The most popular ones, the most frequent ones will be sent over to us and we'll answer them with wit and brevity, I hope. I'm going to get us started because I'm a journalist and I love asking questions. So you'll just have to be a little bit patient and bear with us. Fran, I'd like to start with you maybe, since you're sitting in the middle, you know, the target zone. We obviously heard from your boss, Tim Buckley, today. I gather you had helped him a little bit with some parts of the speech as well. The wins are clearly in the sales of the ETF industry. Frankly, I can't move without some active manager complaining to me about the blob of passive investing, destroying capitalism, the world, and probably devouring the sun at some point. But obviously, it hasn't been around for that long, so it'd be really interesting hearing your thoughts on how far we've come now and which stage are we at in the development. I mean, these are the first of 20, 30 years. What do the next 5, 10 years hold?
Yeah, sure. Thank you, Robin. And as Tim mentioned earlier this morning, I think we're in the very early stages of this low-cost revolution. I think when you think about sophisticated investors who have information and transparency and knowledge Tim credited the audience. Really, it's not. Vanguard's been around for 45 years, pitching costs matter and the benefits of costs. And so while we think we've been a big part of that, we actually think it's the stewards of capital, people that are making really good decisions on behalf of themselves and or their clients to what the facts say. And the facts are very clear that costs are a very important driver. So when we look at it, there's been incredible growth towards ETFs and indexing, but there's still $7 trillion in mandates that are high cost, and that's just in the fund world. There's $50 trillion outside of 40 Act funds that are either self-managed, held directly. So I think we're in the very, very early stages of this.
Do you think it's going to be a $50 trillion industry inevitably?
We hope so. It would benefit investors.
Yes, no, that's a good point. I mean, Dave, I talked to a lot of active managers, and it's interesting to see how their thinking about this has evolved. And obviously, there's a lot of complaints. The interesting thing is being that the amount of people that tell me they think the growth of index investing is going to slow basically disappeared. I mean, basically, people are now just looking at how bad, from their perspective, it is going to be. But it'd be interesting to hear your thoughts on whether there is something that we could call peak ETF, something that at some point things just do start slowing down. There is some sort of inflection point.
Yeah, so I don't think there actually is the ability to have a peak ETF, because if you break that down, the ETF is just the wrapper that is predominantly being chosen from the investment mandate perspective. And so you have active, you have multi-asset, you have all of the different investment outcomes that people are seeking, but it's just they're choosing the ETF wrapper. And predominantly here in the US, we have a lot of advantages, the ETF wrapper through tax efficiency, through intraday liquidity, all of those items that are really building out. And so it's more of a question is there a peak passive, or is there a peak rules-based investing compared to actually a peak ETF?
Or is there a peak?
No, I don't think there's actually a quantifiable number that you can put out there saying, okay, if the $50 trillion and $25 trillion is passive, then we have a problem. Yeah. Because I think when you look at it, so much of the decision making is still active in nature. Even if it's rules-based, you're still sort of choosing when you're rebalancing, what type of rules are going into that rebalance process. Or even really, if you think about it, a lot of active investing is really utilizing the passive vehicle. And so if I choose to go long EM and I go out and buy an ETF that's passive, that dollar gets counted into the passive side. But I've made that active choice to go and do that. And so there really isn't that notion that the ETF or the passive side can get too large, because everything that's underlying that, every investment decision that's underlying that is somehow active in nature. And so there is the bet of, if I say I'm going to go US large cap, and Dan says he wants to go emerging small cap, we're each making active choices, but we're doing that through the implementation of a passive vehicle.
Mm. Yeah, well, I mean, large cap US equities is my personal theory that's kind of going the way of the dodo at some point, probably quite soon. Nick, I'd like to switch over to you. I mean, I remember Matt, who obviously organizes, he once told one of my colleagues it was the manifest destiny of ETFs to basically rule the world, as it were. But how important are costs? I mean, everybody said we add value and blah, 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 but clearly it's a shift from expensive to cheap. Is that going to change? Is that going to continue?
So I think you're hitting the limits of where costs get down to. There's a certain level of sort of support. We launched our range of portfolio ETFs about 3 months ago. We've raised about $8 billion during that time, and that's been staggeringly successful. And I want to thank everyone who's invested in them. It took an awful lot to get them down to price points where they were either cheaper than or equivalent to everyone else out there. And I think we're getting to the sort of limits of where you can get to. No one would have bought them if they weren't already at scale and liquid. So these were funds that we launched with existing assets in them. And so as you look at that space, simply being low cost isn't enough. They have to be an attractive product. No one buys the third brand of Coke. there's no reason just because something is better on one particular dimension that you're going to buy it. It's got to meet a set of needs for a particular investor, and it has to do that across the board. And so the partnership with TDA was a big piece of it. The availability on Pershing and RBC was a big piece of it. Cost was a big piece of it, but it's a total cost of ownership issue that we've talked about for a decade. In the same way, my colleague here has talked about management fees. We've talked about total cost of ownership in the ETF space, and that had to be a factor in it. And so depending on how people are using them, that's a key part. But I think we're starting to hit the limits. I think you'll continue to see price pressure across the board. You're seeing it in the active space where there's a breakdown now between Morningstar ratings and flows, and it seems to be correlating towards price and flows. So this is occurring across the board. The reason SPY gets bought is because it's a top decile fund most years. Not many active managers can say that. And this goes back to the comments just made. Investing is never passive. People are making an active decision as soon as you buy anything other than the equity. And so you're even when you're buying an ETF, people are looking at performance. Investors are looking at performance. They're not just buying cost. They've heard from Vanguard that performance equates to low cost, and there's a real truth in that. And that's why ETFs have been successful.
But, I mean, that sounds like something I could hear from an active manager. That we're approaching the limits to low cost, we can't squeeze them any closer. I mean, how many people here would like Spider to be cheaper? Probably quite a few, right? And, I feel that that's exactly, we could have heard that last year. But the trends are pretty clear in the index world as well. Why can't costs come down further?
Well, I think they will, but there's a certain just cost of managing these things. And as you get more and more scale into them, you can continue to drive it. And as I said, we got into looking into the prospectuses and how they were designed. We were looking into every part of the index pieces. You're stripping out every single thing. And there is a different demand. So, our large cap portfolio product is self-indexed because the investors who are looking for that don't really care about having S&P 500 exposure. For people who are buying SPY, it's an S&P 500 product, and it's covered by hundreds or thousands of options and futures and everything else. And so there's a cost associated with that. So it depends what you're looking for. You've got to understand what ultimately you're looking to achieve as investors, and then meet the needs of those investors.
Well, I mean, not to just to stay on that point a little bit, and obviously we don't have any representatives from the index industry here, so I feel sort of about beating them up. But honestly, I mean, is self-indexing going to become a bigger thing? Because clearly one thing that I do hear a lot from the industry are complaints that the index providers are still charging extreme prices for the indices, and you guys are all basically under pressure to cut costs. Is that going to become a bigger trend, or is it always going to be a little bit bespoke for some of the sort of odder products?
Yeah, look, I think that the reality is where there's price pressure, everyone will look at ways of reducing prices, whatever those require. We prefer to work with our index partners, and across 12 of the 15, we were able to get them down to prices we really wanted to. And throughout this, with every partner we've had, they've worked very well, and we continue to see the value in branded indices. But in some situations where you're looking at a commodity and the value of the index isn't there for the underlying investor, then it doesn't make sense for us to charge it. And it actually doesn't make sense for an index provider to reduce their cost to give it away. There's a real value for many people, particularly for institutional investors. And that's a value that index providers have spent decades developing. And so it doesn't make sense for them to just give that away. So I continue to look at a bifurcation of the different needs that are there and trying to solve those underlying client needs.
Well, it does seem to be a gap between giving it away and charging the prices that they're currently charging for us. Ted, one thing that obviously, it's hard to move without talking about, the performance of the market. One of my favorite stats was the fact that the S&P 500 had a Sharpe ratio of almost 4 last year. I mean, that's Renaissance Technologies level Sharpe ratio. But to what extent has this bountiful, or this tremendous market for beta in general helped the growth of the ETF industry, and how much can we count on that being as supportive in the next 5-10 years?
Well, first of all, if the S&P 500 had a Sharpe ratio of 4, you should change the structure to 2 and 20. I think the future of ETFs, that's what this panel is about. And if you look at basically the history of ETFs, 25 years, and even back a bit further, we've had an environment where starting conditions, most of us in this room have not been investing for more than, say, 35 or 40 years. But if you go back to the early 80s and you look at conditions that you had there with respect to, say, equity valuations, the S&P trading at 8 times earnings, sporting a 6% dividend yield, treasuries, 10-year treasury at close to 15%, inflation running well north of 10%, so basically stagflation, low to negative GDP growth, low to negative earnings growth, compressed profit margins, super wide credit spreads. Sound familiar? On every one of those dimensions now, you can say that we sort of have the inverse condition with respect to valuations, fundamentals in terms of earnings growth. We have this synchronous global growth phenomenon going on. Profit margins, certainly in the US, are quite wide. And I think, obviously, the ETF, I believe the jury is not out. The jury is back and has declared the ETF the package of choice. There are just so many advantages. And I think there's been perhaps undue focus on the package, looking back over the last years, and the cost efficiencies, tax efficiencies. That's been established. I think looking forward, it's going to be more about the content in the ETF. And I think allocators, advisors, investors, institutions are going to have a much more challenging time generating the returns that they need. So there's really two things to think about. How do you enhance what will likely be lower structural beta returns looking forward? So clearly factor investing, other things, other innovations are seeking to address that. What doesn't get talked about as much is really the risk management side. And I do think there is a radical shift underway where bonds, for the last 40 years, best insurance policy you could ever hold, right? You get paid, you don't pay the premium, you get paid a premium to hold the insurance, and bonds have dependably been a beta buffer during sell-offs. If we do have regime change, if we do have rising rates, if we do have some retracement on inflation, the correlation structure between equities and bonds will change. That has radical implications for how portfolios are structured. So I think an area for innovation is to couple with an ETF structure, and talking about equity strategies, return enhancement, lower return environment, but then also risk management features, defensive features.
Yeah, no, exactly. Well, I mean, it's one thing that I spend a lot of time thinking about, though I haven't come to any conclusions. Dan, I'm obviously, as a financial journalist, I'm obsessed with M&A. Well, I have to. You guys just acquired Guggenheim's ETF business. I mean, one thing I'd be interested in hearing your thoughts on how the structure of the industry will evolve, given that, the big three, we have a couple of representatives here, control 80% of the market. I mean, I think one of my stats is like 30 ETFs control almost half the entire ETF universe, which is staggering. I wonder, do you think that's going to slow? How's that going to change? Are we going to see more consolidation on the fund side, the provider side? How's it going to shake out?
Yeah, that's a good question. So as you mentioned, we've announced the purchase of Guggenheim. It's scheduled to close later this year. Everything's on track. And we did close the Source acquisition in Europe last year. So I think for us, looking at, I think it's already been brought up a couple of times, the ETF, the wrapper itself, fairly commoditized, but it's a fintech innovation, right? To be able to deliver it. The content, that's really where I think the value add comes through. And it's particularly as we looked at the Guggenheim transaction in particular, because almost if you think about like Netflix, for example, in the media space, you have a lot of third-party content, which has been out there. But if you have that ability to look at the index content, whether you develop it yourself or license it, it can really bring overall traffic to your website, to your digital properties. So for us really to expand the content we have through the offering at Guggenheim, we felt it was really, really important. I do think economies of scale matter tremendously, I think, in this industry, and the ability to reach and have varied solutions, because ultimately what we're really seeing through the advent of the internet and what have you is mass customization in many parts of our lives. And now you're really starting to see mass customization in terms of investing. So being able to come through, for example, in Guggenheim with the equal weight S&P 500, their bullet shares technology, which we think is a major differentiator, particularly in a rising rate environment. Being able to have a fixed maturity but still open-ended nature. So all that content we felt was really important about that particular transaction. But then I would say on a larger scale, being able to really increase your economies of scale across clients, across product delivery, it's important. And so we think that consolidation is not finished. There's a huge amount of organic growth, that's left to be accumulated over time by the different leaders in the industry. And M&A can be distracting. So I think this is really where being able to grow organically, but where you can find, for at least for us, unique opportunities like sourcing Guggenheim, very exciting for us to be able to move forward on that. But I think ultimately you're going to look at the bigger industry, like I said, retail, other industries where consolidation will happen. And again, to be able to match these lower prices, lower margins over time, you're going to have to make up for it in volume and ultimately remain a strong fiduciary to all of those clients who own the funds.
Yeah, how does it feel like competing as a non-profit, like Vanguard?
Well, I'd say, obviously, look, if you look at any industry cost curve, it's usually determined by the marginal cost of the lowest cost provider. But I do think that's where the content comes in and matters. And I think it's a degree, if you're able to really own or have unique content that can come in and add value, active or passive, to a portfolio, I think it's going to make a big difference. And I think that's where, again, we continue at PowerShares, having launched our first smart beta factor ETFs back in 2002, that's where we play, is continuing to innovate. We have static factors today. You look in the future as transaction costs come down, will you have dynamic factor exposure, long, short? Will that grow? The ability to rebalance more frequently. So you can really see as the market structure becomes more efficient, that content and the value, even versus, kind of static market cap weighted ETFs is getting cheaper. There's still a huge amount of development and opportunity in that content development.
Yeah, well, obviously, I wholeheartedly subscribe to the idea that content is valuable and people should all pay for newspaper subscriptions. I am going to throw some of the questions out here to you guys because we've got some really good ones. I have to admit, I was depressed to see the top one. Just because I feel it's taken over my life over the past year. But what do you think about Ethereum, Bitcoin, and cryptocurrency? Should we have ETFs in that space? I mean, my personal view, just to shoot that in, is like, I swear to God, I can't go to like children's birthday parties in Brooklyn without some parents sidling up to me and asking me about Litecoin or Dogecoin. So, but interesting to hear, frankly, what you all think. Is this something that is something, you shouldn't dictate to people what they want, and if there's demand, you should provide it. Maybe we'll do it sort of clockwise here.
Yeah, sure. So from an index provider perspective, when we think about anything new, any new asset class, which really the crypto side is that just a new asset class, we want to look at ways of, can we achieve reliable pricing sources? Can we achieve those pricing sources are fair and transparent and not risky in nature? And then if we can accomplish that, can we package the asset into a rules-based, objective, transparent valuation, i.e. the index? And from our perspective, we're still working through that. We're still understanding of really what can be done on that side. And I think until that nature is really solved from the valuation of the crypto, it's going to be hard to get a provider to come in and package that into the ETF wrapper. And I'll note with Nasdaq as an exchange over in Sweden, we do have 2 ETNs listed, which have been very successful, have done a good job in terms of delivering the value that they're supposed to, with all of the the root risks that can occur off of that. And then obviously the SEC, which I'll allow some of the providers to comment on, did come out with more of a question, I think 5 sort of distinct questions on to answer before the ETF can really come into space. But I think really it's that valuation metric that is.
But do you think we're going to get one? Do you think in the next year or two we're going to see a Bitcoin ETF?
My personal belief, separate from my employer, is no. I think we're probably 2+ years away.
Oh, really? But you do think one's coming?
There is an eventuality to that, like all things. Like every asset class that we've uncovered from the ETF perspective, going all the way back to 500 stocks, to gold, to interest rates, et cetera, it's always happened.
And Ted, I mean, in 2 years' time, are we going to have a Bitcoin ETF, yes or no? If so, why?
I believe if you do have the ability to price, to deliver, to trade it efficiently, we'll have it because there's demand. And I think the way that you framed it's an interesting question. Should our industry express kind of a moral view, right? Are we to say that Bitcoin or any asset that has no cash flows attached to it, it purely is a function of supply and demand and really investor emotion or agents' emotion in that market? I don't think we should. If there is demand for exposure, one thing we should remember about ETFs is they're not only vehicles for going long, but they're vehicles for going short. So I think having the ability to more efficiently, if we can be more efficient than, say, a closed-end fund and have closer to NAV pricing, it makes sense. Now, from a personal perspective, I do think Bitcoin probably is going to come under pressure because my 75-year-old mother asked me about it, and I did advise her not to establish a Coinbase account and buy Bitcoin. So that's personal morality versus an industry view.
No, but I can see the point that personal morality shouldn't enter into it. I mean, that's a slippery slope. But you guys you have a fiduciary duty. If you think that this is, I'll put my own word, dumb, then should you really be allowing your investors your clients to put money into it? I mean, Fran, what are your thoughts on that?
I just wanted to start off on something that was said earlier about nonprofit. So Vanguard's structure is we are aggressively for profit. We are not a nonprofit. We compete aggressively for profit. It's what we do with the profits.
Yeah.
We're shareholder owned, and so we return the profits back to our investors. And so that's our structure. I just did want to clear that
By
up.
lowering costs, that's
As it relates to, Vanguard has a history of innovation, but we also are very selective in product development. When I look out there, we have just north of 70 products, which looks very small relative to the almost 2,000 products that are out there. We really want to make sure that the asset class is enduring. We want to make sure that we can actually fundamentally understand where the free cash flow or what is the value proposition of the asset class. So you can really tell that from real estate. You can really tell that from a corporate bond, a treasury bond. You can clearly tell that from public equity. For us, we're having a hard time, we have to separate, first of all, blockchain technology, which we think is actually very, very innovative and disruptive to this industry. So put that aside and then talk about the cryptocurrency, of which we're still not sure how you would think of it other than a speculative investment as opposed to where are the returns coming from. So I wouldn't expect us to have anything like that in the next 2 years.
No, I would be surprised. So let's move over to some of the questions here. Top one now is, are firms like Morgan Stanley and Bank of America choking off innovation by not allowing small ETFs onto their platforms? Could that harm the ETF revolution? That's quite interesting. Dan, I'm interested in hearing your thoughts on that.
It's a good question. I just look, obviously Morgan Stanley, Bank of America, Merrill, and the wires, the big broker dealers are all, strong fiduciaries to their clients. And I think if you look at the scale of their businesses, the ability to make sure that they're offering kind of the right solutions, it's a lot there. And I think having the resource time to look at every single 2,000 plus ETFs available, I think it's a pretty daunting task. But from our work at Invesco, those firms do a great job. Additional resources they're committing to looking at ETFs, but not just ETFs, but active funds, looking at other solutions to make sure, I mentioned the term mass customization. I think that every one of their clients ends up getting the appropriate outcome. So it's hard to say. I think for the smaller ETFs, definitely to get traction, to build track record, get the liquidity necessary. I think those are important screens that these large fiduciaries really take into consideration. But again, we see those firms put particular care and focus on their fiduciary responsibility. So I don't necessarily see it as a problem. But again, we're one of the top 4 or 5 players in the industry.
Yeah. Anybody else have any thoughts on that?
Yeah, I don't think they are. I think that the reality is it applies to all providers. I don't think they're choking off innovation. I think we're hitting saturation point in terms of ETFs. We've reduced the number of ETFs that we launch. We're launching far fewer than we have, and we're only launching ones we can get behind. And the idea that anyone can just throw a few ETFs up there and see them trade is a fallacy. Investors don't want to buy an illiquid fund, and for Morgan Stanley and BAML or anyone else to put them on their platform adds a whole load of cost to all the investors. There's a whole load of maintenance that goes into that for not particularly an improvement in customer choice. If investors want to buy it, they will go and buy it, and you'll see the flows come in, at which point they'll make their way on. But that then puts pressure on us to actually deliver that. I did want to say one thing to your Bitcoin thing, and I'll cut this off. No, we should not be doing it. If our role is to help investors invest wisely and save for the future, then supporting a speculative instrument is against the ethos of our industry.
Yeah. Yes.
The only thing I would say in response to that, and I respect your opinion, I'm not a Bitcoin or crypto coin or token supporter. However, living in San Francisco, you can imagine that there's quite a bit of, what shall I say, enthusiasm for cryptocurrencies. And now having spent time with folks who are involved in blockchain and various crypto ventures, while I don't buy into it, there are some very, very compelling arguments that are made. And I think the other side of the coin, no pun intended, is if we are preventing investors from establishing exposure to something that could be of value and something that is a return enhancing and even diversifying asset, I'm not sure we should stand in the way. But I respect your opinion.
Tulips were a diversifying asset. Tulips in the 16th century were a diversifying asset. If ETFs were around, we probably wouldn't have built one today.
My favorite example is Seth Klarman at Baupost. He's written a book called Margin of Safety. He has this anecdote about sardines. Apparently there was a sardine shortage on the West Coast 100 years ago or so, and people started buying sardine cans. The price started spiraling. It became a classic mania. At one point, one very successful trader decided he was going to celebrate a really good deal by eating a can of sardines, opened it, and it stank. It had gone rotten. It was horrible. So he went over to the seller and said, "Dude, you stiffed me. These are bad sardines." And the guy said, "Well, you're an idiot. You don't understand. These aren't eating sardines. They're trading sardines." But this is like, for me, like, I think some of the technology around this is interesting, but fundamentally it's a digital widget that means nothing. And even if we do some financial alchemy with futures, it doesn't mean that the underlying thing is actually real.
I agree. I just think what's interesting, though, is Niall Ferguson has a new book out, Tower and Squares. If you read through it, it's the trade-off between hierarchy and networks. So I think underlying blockchain, we all agree, has tremendous opportunity. You deal, whether it's global monetary policy, what have you, there's a hierarchy that's been in place, Federal Reserve, central banks around the world. But having a network approach, something like Bitcoin, again, not as an intrinsic investment, but that technology challenging the hierarchy can be good. If we can potentially get that blockchain and other more efficient technologies embedded in the system, takes out costs, removes frictions, and frankly makes it more efficient for buyers and sellers.
Yeah. Well, I mean, I don't want to, well, actually, I do want to spend lots of time on this, but we want to get some other questions. But, I mean, fundamentally, we're talking about introducing an ETF that somehow trades or contains some crypto. Isn't the danger there that we are making something? One thing is if some housewife or I mean, I saw a New York Times piece about some cleaning lady on the West Coast buying crypto on the side. I was shocked. I think that's horrific. That's terrible. And the sad thing we see from the history of bubbles is always the little people that end up basically carrying massive losses. An ETF would just, like right now, that cleaning lady or that housewife will have to open up a Coinbase account or do something. There is some grit to prevent that becoming mainstream. But if we introduce an ETF, aren't we just going to flim-flam up an even bigger bubble and make it easier for people to get involved in this?
Have you opened a Coinbase account?
Is it?
It's like 5 minutes.
Oh, okay.
Yeah. So I mean, I
Hard
think
to close one though, apparently.
Actually, that's true because I last had one. I last had coins in 2013. Unfortunately, I never held them, but it's still an open account. So that I don't know about the closing side, but the actual opening. So that's why I would disagree that the ETF would then just open up a huge wave of new investors.
It gives it a veneer of legitimacy. It's a mainstream financial product that is getting pushed to everybody.
But I think if you look, for example, the couple of futures contracts are trading, right? They don't settle in Bitcoin, they settle in US dollars, right? So effectively, you're having a futures contract that's just based on a very volatile underlying asset, effectively. So I think that is very different than obviously having something where you're going to take settlement risk and all of the potential complications you have getting out of Bitcoin or these cryptocurrencies. Okay. And that has not been approved, and it doesn't appear it will be anytime soon.
Yeah. Let's move on to something because there's some very good questions here, actually. Is there a doomsday scenario for ETFs? What keeps you up at night, and what could go wrong? Again, also something I'd like to ask to everybody, but I mean, Ted, maybe what keeps you up at night surrounding some of the issues around the ETFs?
Well, look, I mean, we've had just a force field of flows into ETFs, right? So it's been a one-way trade for the last 10 years. If you think about market structure, fragmentation, liquidity provision, to the extent that we do have a market shock and that reverses, can the market absorb? In other words, is the capital, the banks, the brokers, is it there to be committed? You can make the argument that there's less in play. Then fragmentation in terms of exchanges and other means of executing. Again, there could be some potential risk there. So I do think if you got a really, really strong unwind, you could see some very odd things occurring in ETF pricing.
Fran, I mean, you work for the world's fastest growing asset manager, so you probably sleep really well at night. But when you do have nightmares, what are they about?
Well, first off, I have 5 children, so sleeping really well at night goes out the window a little bit with that. I think we get a little bit confused on, let's take what the acronyms stand for. The ET is exchange traded, and underneath is the fund, right? And so the fact of people keep pointing to the flows and they see, $1 trillion into the ET, but $1 trillion came out of high cost active that have betas and correlations that are almost 1 for 1. So this has been a substitution of high cost, low value, the F, let's get the F right, that's fund that holds securities, and move to a lower cost exchange traded fund that holds almost the identical same securities. So the idea that there's a doomsday scenario coming, that doesn't mean there cannot be a bear market, right? There's been a bear market in 2000 to 02 to 08, but that was because of fundamentals of the market, whether they be valuations or investors' appetite. They want to de-risk, but it has nothing to do with the E or the T or the F.
Well, I mean, there's another question on this. As more money moves into ETFs, does this create new systemic risks? I mean, deal with the ET side. And Dave, I'd be interested in hearing your thoughts on this because, for me, we've had bear markets long before the ETF existed. People have been doing dumb stuff with money for as long as money has existed. But clearly, we've never had a market that the structure has changed subtly. And it'd be interesting, I mean, we obviously had August 24th, but how worried should we be about this? I mean, where do you think the fault lines or the fractures might occur?
Well, I think with this system, and this is going to the point of the E and the T, that the exchange trading mechanisms that exist, being able to have net asset value, and then being able to have market makers and APs and the entire network around price, and then take advantage of price dislocation. And with the advent and probably some of the advantages that like high frequency trading and technology has really brought to exchange trading, I think any of those dislocations to occur, they will be immediately gobbled up. That there will always be somebody there looking to either take advantage of a dislocation on a price, or take in a delivery of the securities for other reasons, internalization, all the other aspects that can exist to that we see with a well-run market across the United States. It's hard to say that just because flows would stop or the market would go down, that the ETF would actually exacerbate anything beyond just what we normally experience throughout the course of the last 200 years of trade.
I was just going to say, I think the factor that always seems to come to play, whether it's tulips or mortgages, is leverage. And this is where, again, maybe a very, very small percent of the ETF market clearly uses some degree of leverage in the product, but for the vast part, these are not leveraged products. So if there's something more systemic, for example, margin accounts, leverage through that or through the wider system, that could be an issue. But in terms of the product itself, I mean, these are fiduciary-driven funds. In the U.S., 40 Acts that have been tested, obviously, over long periods of time, as well as dot-com bubbles, as well as credit crisis. So they've had pretty big stress periods. So I think the structure itself, but if we found some way that ETFs were incorporating or being part of a larger leverage associated with an asset bubble, that would get me worried, but I really can't see that today.
I agree with all of that. I think there's a different point as well, though. Even though 40 Act funds have been around for a while, when you see a blow up in a 40 Act fund, in a traditional mutual fund, somehow it doesn't translate into this industry is bad, and we need to, we need to scrutinize it even more. So even when you saw some of the fixed income problems that took place last year, that didn't translate.
But it did translate. I mean, we've seen countless funds blow up, and it leads to more regulation or new rules. I mean, if you're talking about the credit fund that blew up in December of 2015, that did lead to the SEC formulating new rules.
But it didn't. It didn't fundamentally undermine investors' belief in the in mutual funds.
No, I mean, no.
And I think where ETFs come in, that is an advantage, is you don't have the race for the exits, because at least in a non-cash create redemption structure, the fund managers does not have to sell. So the costs and the risk is borne by the people selling, not by the people who stay in the fund. So there's actually an advantage in a crisis situation. Where I'm worried in the doomsday scenario, the thing that keeps me up at night is we are making two promises to investors. We're making a fund management promise, which I think most of us do very well, and we're making a liquidity promise. And when the liquidity is reliant on a lot of other pieces, and the ability to support that is really, really key. And I worry that we'll see smaller providers who can't support the resources needed to keep the market structures in place that many people on this panel have, that something blows up there, and that translates into a loss of comfort with the structure as a whole.
Yeah. Well, my assumption has been that there'll be some market mishap, and rightly or wrongly, ETFs will get blamed anyway. But we have time for one last question. And since this panel is about the future of ETFs, I thought there was a really good one here. Could you see ETFs being replaced by digital? No, here was another one. Well, anyway, I mean, the future of ETFs. I mean, is the ETF the final station in the investment vehicle? I thought that was an interesting idea. Like, can we improve on the ETF structure? Is this just like the technology that we use now, might use for the next 10 years, but is it, where could you improve it?
Well, just started to kick off, but I think the market structure, I think we've all agreed to make sure that we're aligning, obviously, individual equities, ETFs, and even futures contracts, that we have a very good dynamic system of trading those. So that's at a macro level, but in terms of the actual product itself, I do think there are obviously of the structure of ETFs evolutions that do take place, but I think it's much more of the market structure. And not just in the US, but now you're seeing with MiFID II in Europe and other places, these global regulations are really starting to impact other jurisdictions. And I think again, we get the F part is the fund, domestic, but the ET is global. These are also listed securities, so you have to take into consideration all of these global regulations around it.
I think we're fools if we think this is the final chapter in financial investing forever. You know, of course there's disruption. There's disruption in every industry. I do think this is a very strong structure and it will last for a long period of time. I think there's value in a pooled vehicle that everyone knows what's in it and they can trade off the back of that. I think the struggle that bespoke tailored index providers have had is most investors, even professional investors, don't actually want to take the time to have to figure out exactly what they want to invest in down to the last percent. And there's a real value in having that tradable vehicle that everyone knows what it is. It's the same reason futures exist. It makes life a lot easier for everyone, and you can focus on the things that do matter, like asset allocation. But yeah, at some point, I'm sure there'll be an innovation that will disrupt it. I don't know when that will be, but I think we've got a long time to go still.
I would agree with that. So we're here at the 25th anniversary of the first U.S. listed, and so it's still, again, I would keep coming back to the early stages. To think that 25 years from now we could not improve upon this, whether it be the ET part or the F part, I think that would be a little naive. There's been innovation and disruption through time, but I would still, think about just how improved we are today than where we were 25 years ago. The dollar-weighted expense ratio has come down in the last 15 years from 91 to 50. And so the end result is a lot of these dislocations are helping advisors, helping end clients. You know, you think about if you're saving money deferring utility today for some future hope of having a higher return. And so the innovation has been an incredible gift to end investors. And I think us on this panel will keep trying to push us forward to continue that innovation.
I'm sure there will be innovation. That said, I think when you look at ETF as a package, what attributes of a package would you be valuing? From a cost perspective, certainly we've made significant progress there, and there's a huge advantage. There are other costs that are unseen, so externalization of transaction costs, so that investors in a fund are not being penalized by activity of others, as well as at scale, where there's a secondary market for ETFs. The ETF can trade at an improved spread over what the collective or the weighted average spread would be for the underlying basket. So cost efficiency, obviously tax efficiency, which I believe has been undervalued. There was a fund, I will not name names, it was highlighted in a number of places, including Barron's, But basically, there was an S&P 500-based index mutual fund that had somewhere between a 30 and 35% capital gains distribution this past year. So basically, there were outflows from the fund, and appreciated positions were sold. That kind of thing, in terms of you got the index return, and that fund was expensive, by the way, like probably 40 times what, what a Vanguard vehicle would be. So the tax efficiency, portability, you just have these features where it really, it's hard to imagine what are the other dimensions that you would think about? Cost, tax, liquidity, transparency, right? So you have full transparency to all underlying holdings, assuming it's a transparent ETF.
Yeah, I would just note, I mean, I think the tax efficiency part, which is extremely important, is one of the things that would actually give more opportunity for innovation down the road. Because if there is a regulatory regime change or some sort of intervention from the for the U.S. with the SEC, whether in Europe with other regulators, that could help force innovation, help change the policy, change the rules, and then force either ETF providers, force index providers to change course and move forward. I mean, that would be something that could be more impactful, more immediate to drive change. Otherwise, I think it's the continued incremental burn of innovation that we see, where you almost take advantage of it. When you take out an iPhone X and compare it to an iPhone 3, they're wholly different devices. Yet it was just a slow burn where you think, oh, it's still just an iPhone. But there has been massive innovation in that, and I think we see that with the ETF 25 years ago versus the ETFs that are launching today, yesterday, every day. There are slow innovations that are coming up that you don't really notice. And so I think we'll continue to see that, and it will probably take some sort of external factor for there to be some massive change in terms of the ETF structure.
I'm hoping that there's more innovation on the content side. Again, I think we just very different market context, looking forward, very different relationship of how assets correspond to one another. And I think there's a lot of things that we can do as an industry in terms of being creative, and again, thinking about how can we best serve investors in ways that perhaps have not been delivered, that's not been delivered yet in a great package.
If I could just add, I think maybe the innovation, the ETF itself is the microprocessing chip, right? It's fairly advanced. We're always kind of like an Intel chip. We're always improving the speed and processing power of that chip. But I think if you take it to the larger ecosystem, whether in the fintech area, whether it's robo-investing, but I think there seems to be that the microprocessing chip is pretty efficient, but now we're really moving to a world where that ecosystem that actually delivers returns and performance to the end clients, that's where I think a lot of the catch-up's going to be. The ability to get asset allocation models, the dynamic rebalancing, holistic wealth management, all of that becoming much more efficient between human involvement and the robo piece to the ultimate better outcome for clients.
Okay, well, I think we'll draw a line under that. Can you please put your hands together for my wonderful panel here? And if you have any more questions that you want to ask them, and then ask me, and I'll ask them at some other time. Right about it.